Hello, everyone. Here is Gemini AI. Okay, let's talk about something that's, well, it's tough, but so important. We're going to be walking through what happens with finances after a loved one passes away. And specifically, we're zeroing in on how to handle their final tax return.
So in this guide, our goal is simple. We're going to walk through, step by step, how you can understand and claim medical expenses on that final tax return. I know, it can feel a little overwhelming, but I promise we're going to break it all down so you can tackle this with total confidence. All right, so let's just get right to the biggest question you probably have on your mind. Can you even do this? Can you claim these medical expenses? And the answer is a big, clear yes. You absolutely can. And in this explainer, we're going to show you exactly how it all works. Okay, so the first thing we've got to wrap our heads around is the timing. This isn't your typical January to December tax year. Nope, the Canada Revenue Agency actually gives you a special, kind of flexible window to work with for these expenses.
And this is actually pretty great because it gives you some real flexibility. You get to pick any 24-month stretch of time that works best for you. But there's one rule that's set in stone. That 24-month window has to include the date of death. So, it could start way before and end a few months after, or it could start the day they passed and go for 2 years. The whole point is for you to pick the window that lets you claim the most possible expenses.
So just to be super clear, there are a couple of ground rules. First, like we just said, the date of death has to fall somewhere inside that 24-month period. And second, and this is just common sense really, you can't double dip. Any expense you claim here can't have been claimed on any other tax return by anybody for any other year. This is a one-shot deal for these specific costs.
Okay, so let's say you've picked your 24-month window and you've gathered up all the receipts. Awesome. Now we're on to the next big step. We need to figure out the actual dollar amount you can claim. And it's not as simple as just adding up all the receipts. There's a little bit of math involved.
Right, here's the deal. You don't get to claim every single dollar you spent. It's kind of like a deductible on your car insurance. The government sets a minimum amount. They call it a threshold, and you can only claim the expenses that are over that amount. Think of it as a floor you have to get past first.
So the big question is, how do you figure out what that threshold is? Well, you're actually going to look at two different numbers. And then, and listen up because this is the most important part, you get to use whichever of those two numbers is lower. So let's break down those two options.
Option A is super easy. It's just a flat number that the government sets each year. Right now, that number is $2,759. So just tuck that number away in your brain. That's one of your two key figures.
Now, option B is tailored to the person's specific finances. What you're going to do is look at the final tax return, find line 23600, that's the net income, and then you'll just calculate 3% of that number. Simple as that. Okay, let's just hammer this point home, because it really is the most important rule in this whole calculation. You've got your two numbers, right? The fixed amount, that $2,759, and the 3% of net income you just calculated. You put them side by side, and you pick the one that's smaller. That smaller number is your official threshold. It's actually a rule that's designed to help you out.
All right. Talking about it in theory is one thing, but I find it always clicks when you see a real example. So let's make up a person, we'll call them Alex, and we'll walk through this whole process from beginning to end. It's a really simple 5-step process. We'll grab the income, run the numbers, compare our two options, pick the winner, the lower one that is, and then do one last bit of subtraction to get our final answer. Sound good? Let's do it.
Okay, here's the info for our example with Alex. We'll say that Alex's net income, right from line 23600, was $45,000. And during that 24-month window we talked about, the family racked up $5,000 in medical bills.
All right, step one of the math. We take Alex's net income, that $45,000, and we find 3% of it. So $45,000 times 0.03, and that gives us $1,350. That's our option B number.
Okay, now for the showdown. We compare our two options. We have the number we just calculated, $1,350, and we have the fixed government number, $2,759. Which one is lower? Yep, it's pretty obvious. It's the $1,350.
And there we have it. That's Alex's threshold. So for this tax return, the first $1,350 of medical expenses can't be claimed. Now we're all set for the final piece of the puzzle. All right, here's the last bit of math. We take the total medical expenses, remember that was $5,000, and we subtract that threshold we just found, the $1,350. And what does that leave us with? $3,650. That is the magic number. That's the amount you can actually claim on the tax return.
Perfect. So we've done all the calculations, we have our final number. But now, what do we do with it? Where on the tax form does this thing actually go? Okay, you're going to take that final number. For Alex, it was $3,650, and you'll put it on line 33099 of the final tax return. Now, there is another line, 33199, that you'd use if you were claiming for a dependent. But for the deceased themselves, it's 33099. And listen, this is super, super important. You have to physically attach copies of every single receipt when you file the return. Don't forget that part.
Okay, before we finish up, I've got one more little bonus tip for you. Because sometimes when you claim these medical expenses, it can actually open the door to another credit. And this one is refundable.
It's called the Refundable Medical Expense Supplement, and it could be worth over $1,400. Now, that word refundable is huge. It means that even if the person doesn't owe any tax, the government could still send money back. It could actually result in a refund check.
So, how do you know if you qualify? Well, it basically depends on having an amount claimed for either disability supports or, you guessed it, medical expenses. You don't have to worry about some crazy new calculation. The tax software or the forms will usually guide you through it. If you want to see all the details, just look for line 4520 on the return.
And that's pretty much it. We've unpacked that tricky 24-month rule, and we've walked through the whole threshold calculation. But you know, this is just one part of a much bigger picture. Which leaves us with a really good final thought. Now that you know about these special rules for medical stuff, what other unique credits and deductions might be out there for a final tax return? It's definitely something worth looking into.